A very good morning to one and all. My name is Aditi Bari, a student of Deep Education Society, Stas Institute of Management and Studies. Today I am going to present a PPT on derivatives, risk and management. My topic name is financial derivatives. What are derivatives? A derivative is a financial instrument whose value is derived from the value of another assets, which is known as underlying. When the price of the underlying changes, the value of the derivative also changes. A derivative is not a product, it is a contract that derives its value from changes in the price of the underlying. Example: the value of gold future contract is derived from the value of underlying assets. Traders in derivatives market. There are three types of traders in the derivative markets. Hedger. The hedger is someone who faces risk associated with price movement of an asset and who use derivatives as mean of reducing risk. They provide economic balance to the market. Speculator. A trader who enters the future market for pursuit of profits, accepting risk in the endeavor. They provide liquidity and depth to the market. Arbitrator, a person who simultaneously enters into transactions in two or more markets to take advantage of the discrepancies between price and these markets. Arbitrage involves making profit from relative mispricing. Arbitrators also help to make markets liquid, ensure accurate and uniform pricing, and enhance price stability. They help in bringing about price uniformity and discovery. OTC and exchange trade derivatives. OTC, over the counter or of exchange trading, is to trade financial instruments such as stock, bond, commodities, or derivative directly between two parties without going through an exchange or other intermediary. The contract between the two parties are privately negotiated. The contract can be tailor-made to the two parties. Linking over the counter markets are uncontrolled, unregulated, and have very few laws. It's more like a free fall. Exchange traded derivatives. Exchange traded derivatives contract are those derivative instruments that are traded via specialized derivatives exchange or other exchange. A derivatives exchange is a market where individuals trade standardized contracts that have been defined by the exchange. The world's largest derivative exchange are the Korea Exchange. Economic benefit of derivatives: reduce risk, enhance liquidity of underlying assets, lower transaction cost, enhance liquidity of the underlying assets, enhance the price discovery process. Portfolio management: provide signal of market movements, facilitated financial markets integration. What is a forward? A forward is a contract in which one party commits to buy and the other party commits to sell a specified quantity of an agreed upon assets and predetermined price at a specific date in the future. Risk in forward contracts. Credit risk. Does the other party have the means to pay? Operational risk. Will the other party make delivery? Will the other party accept delivery? Liquidity risk. In case either party wants to out of the contract, how to find another country party counterparty. Closing a future position. Most futures contracts are not held till expiry, sorry, but close before that. If held till expiry, they are generally settled by delivery. By closing a future contract before expiry, the net difference is settled between traders without physical delivery in the underlying. Terminology. Contract size, the amount of the assets that has to be delivered under an one contract. All future further future are sold in multiples of lot, which is decided by the exchange board. Contract cycle, the period for which a contract trades the future on the NSE have 1 month, 2 months, 3 months. Expiry cycle. Expiry date usually last Thursday of every month or previous day if Thursday is publicly holiday. Terminology. Strict price, the aggregate price of the deal is called a strike price. Cost of carry, difference between strike price and current price. Margins. Initial margin deposit that a trader must make before trading any future, usually 10%, is the contract size. Maintenance margin. When margin reaches a minimum maintenance level, the trader is required to bring the margin back to its initial level. The maintenance margin is generally about 75% of the initial margin. Variation margin, additional margin required to bring an account up to the required level. Marketing to market. This is the practice of periodically adjusting the margin account by adding or subtracting funds based on changes in market value to reflect the investor gains or loss. This leads to changes in margin amounts daily. What are options? Contracts that give the holder the option to buy sell specific quantity of the underlying assets at a particular price on or before a specified time period. The word option means that a holder has the right but not the obligation to buy sell underlying assets. Types of option. Option are the two types: call and put. Call option give the buyer to the right but not the obligation to buy a given quantity of the underlying assets at a given price on or before a particular date by paying premium. Puts give the buyer the right but not obligation to sell a given quantity of the underlying assets at a given price on or before a particular date by paying an premium. Options terminology. Underlying specific security or assets. Option premium. Price paid. Strict price. Pre-decided price. Expiration date on which option expires. Exercise date option is exercise. Open interest total number of option contracts that have not yet been expired. Option holder one who buys option. Option writer one who sell option. What are swaps? In a swaps, two counterparties agree to enter into a contractual agreement wherein they agree to exchange cash flow at periodic intervals. Most swaps are traded over the counter. Some are traded on future exchange market. Types of swaps. There are two main types of swaps: plain vanilla fixed or floating swaps, or simply interest rate swap. Fixed or fixed currency swap, or simply currency swap. What is currency swap? It is a swap that includes exchange of principal and interest rate in the currency for a same in another currency. It is considered to be a foreign exchange transaction. It is not required by law to be shown in the balance sheet. The principal may be exchanged either at the beginning or at the end of the tenors. Thank you.